Settle down. Good morning. So, I think, what was the last discussion we had yesterday? Notes. What was the last thing we have written? Chinese experience. We were writing Chinese experience? Yes. Any doubts you have? No doubts, everything is clear. Okay, so we have written India's India and household savings rate is not as high as India. Yes, that is the last thing, right? Okay. So put the go ahead with the notes. Next paragraph. Yes. Write down. India's growth model. Write down. India's growth model. India's growth model. Write down. India's growth model is different from investment export oriented strategy of China. India's growth model is different from investment export oriented strategy of China. Okay. So you'll listen to me for 2 minutes and then we will write. Okay. Now, first question is, do you all know what is trade deficit? Is it done in class? Okay. Okay. But you know. Okay, very good. So that is one. See here, how was China different from India? If you have to observe. So when we talk about China, with respect to China, mainly it was foreign investors. Listen very carefully. Foreign investors invested in China. Foreign investors invested in China. They started producing goods. They started manufacturing in China. And whatever goods they produced, they started obviously to focus on what? Exports. It means China's growth was mainly coming from external sources. External sources means, one, it is the foreign investors who are responsible for growth. Two, mainly dependent on exports to other countries. That means Chinese growing based on external sources. But if we talk about India, so India's case, how was India growing? Now, if this is India, so India's case, our growth was not mainly coming from these investors. Our growth was mainly coming from our income, household income, getting converted into savings. From our household savings, private player is taking loan, or there is some investment or this production happening. Okay. And this production also, we were mainly focused on selling it to somebody within India. Are you able to get this? No, this is the difference. I think you have understood. Okay, that means our growth was coming from internal sources. Chinese growth was mainly coming from external sources. This is a basic difference you should understand first. Number one. Number two, how can I say this? How do I say that yes, India's growth was mainly coming from internal sources? It is by, see here, India's case, if you observe, India's case, in spite of having trade deficit. Now this I will not dictate because this one you will do in the different class. Dictation, I'll only explain. So this will be in a different color, as I mentioned. Okay. So this is a little offset of the regular topic. So here, if you observe India, in spite of having trade deficit, India was having huge trade deficit. Even today also, we talk about trade deficits, trade deficit. Now let's try to understand what is this first. Okay, so when I use the word trade, listen very carefully. When I use the word trade, okay, trade mainly deals with two important aspects. Trade deals with something called as one, exports, okay, and two, imports. Okay. When I say exports, I am selling products or services to other countries. I'm selling products or services to other countries. This is what is export. Okay. So in return, when I export, they will make payments in dollars. That means when I export, there will be something like dollar inflow. Is that okay? When I export, there will be inflow of dollars. That is one. Next, import is something like I am buying products. India is buying products or services from outside. So obviously, we will make payments. We have to make payments in dollars. Or import is something like you will find that there is dollar outflow. It's a very simple way to understand. Very simple way to understand. There will be dollar outflow. Okay. So let's say exports we have got somewhere like $250 moved into India. Okay. And because of import, outflow was something like $500. Outflow is $500. Inflow is $250. Okay, so what is left in India? What is left in India? Simple, 250 came in, 500 went out. That means obviously what will be left? Minus 250. It is minus $250 that will be left in India. This minus is nothing but deficit. There is a deficit. And this deficit is because of what? Trade. And therefore I call it as trade deficit. Trade deficit. Is that okay? So trade deficit means obviously trade deficit means my imports are more than export. Trade deficit means imports are more than exports. I think you're getting my point, right? Imports are more than exports. I am using the word called trade deficit. I think the word trade deficit is clear. Okay, so when we are writing, I'll just mention what is trade deficit there, but some students know, some don't know, but you'll be discussing this. Again, I will also touch this when I'm touching economic reforms in 1990, that is 8th 5-year plan. 8th 5-year plan, 1992. Okay, so now trade deficit, how can I say India's growth is from internal sources? How can I say India's growth is from internal sources? Is India, in spite of having huge trade deficit, that means what we observe in India is, though we have trade deficit, India's case, we have trade deficit. Okay, that means trade deficit means what? Our imports are more than exports. And in spite of this, we were growing at a rate of, earlier we were growing at a rate of somewhere like 9%. Growing means what growth here? GDP. It clearly indicates that exports are important for India also. But still, though in spite of having trade deficit means your exports are less than imports, still India managed to grow at a rate of how much? 9%. It indicates that our growth was not completely dependent on exports, or our growth is not completely dependent on external sources. This is the understanding you should have. Now, whenever external markets get affected, okay, something wrong happens in other countries, obviously China will be more vulnerable. China will be more affected, isn't it? So something wrong happens in other countries, China will be more vulnerable, or China will be easily affected. Why China will be easily affected? Because Chinese growth is dependent on, yes, are you able to get this? So that is what happened in China after 2011 in China. What happened 2011 plus? What happened is across the globe, protectionism. Across the globe, there was protectionism. Why? Because of certain financial crisis impacts 2007-8. US, there was some financial issue. 2007-8. You know that, 2007-8? Okay, so 2007-8 is a very crucial year. 2007-8. Okay, so this was a year I still remember because I was into investment banking where I made most of the investments of the customers. And every customer used to come and ask when my share is going to increase. And I used to tell them, wait. 1 month, wait, 2 months, wait, 6 months. And then I got frustrated. I used to tell them, wait for 6 months. What is your problem? Okay, wait. And then I said, enough now. I am also writing UPSC because hikes are not coming. Financial crisis. Okay, so financial crisis, therefore UPSC. Okay, why? Because hikes were not as expected. Okay, so therefore, so you wait now, I don't know. Next is, see, the challenge here is when it comes to financial crisis, etc. The share markets, stock markets get affected, and those who would have invested, those who have not expected before very properly, they will make some loss. Share market means you get profit as well as loss, no? So I think you got my point. So the impact of this crisis was there after 2011 also. That is, the globe started moving towards protectionism. Then you find that China has, sir, we haven't written challenges of, first of all, we have not written anything, wait. Okay, so not challenges, we have not written anything still. Okay, so we are just in the middle. I have not completed it. Switch off, okay. Clear, no? Yeah, is this clear? Chalo, now you write. Understood, no? Yes, go ahead. Write down. India's, continue, next paragraph we have written India's growth model is different, right? So write down A, first point there. There you will be writing the first point. China has derived predominant part, write down, 1. China has derived predominant part of its growth. China has derived predominant part of its growth from external sources. Both in terms of foreign investment, and export markets. India's growth is from internal sources. Continue. Same point. India's net export to GDP ratio. India's net export to GDP ratio. Export to GDP. India's net export to GDP ratio has been significantly lower than that of China. B, next point. B. India has a large trade deficit. India has a large trade deficit. India has a large trade deficit. Yet it has managed to grow at reasonably high rates. Yet it has managed to grow at reasonably high rates. Understood. Okay, trade deficit is clear, right? Third point, three. This is also one more point. First, right, I'll then explain. Domestic savings to investment gap in India. Domestic savings to investment gap in India. Savings to investment gap in India has been kept at low levels. Has been kept at low levels. And India has managed to finance. And India has managed to finance a predominant part of its capital formation. A predominant part of its capital formation from domestic savings. From domestic savings. Okay, now see, now here what I'm trying to explain there, the third point is, see here, on one side you have savings, okay, and savings should get converted into investment. Savings should get converted into investment. This gap between savings and investment is less in India. That means it shows that our savings were easily getting converted into investment. This gap is less. This gap is less. This shows that our investment, or investment is nothing but what we have written, this investment, that is nothing but what? Capital formation, is mainly coming from our savings. Is mainly coming from our savings. How am I able to say this? Because the gap between savings and investment is less. That is the meaning. Now the question is, I'll ask you one question. Do you think during COVID, the gap between savings and investment would have increased? Huh? Wait. Let her answer. Okay. Okay. No. So the question, she got confused, nothing. So here, I said the gap between savings and investment increased during COVID. Why? Because what do you think are the reasons now? Can you think? Don't use big. One is income. First of all, is during COVID. First of all, incomes. Our income is going down. Okay, no salaries, no jobs. So most of the private players kicked people out of the jobs. Okay, so that was a big challenge for government basically. That's the reason in the government's budget, government was talking about something has to be done. There's a discussion of public investment. In the budget, there's a discussion of public investment. Why? Private investment is not happening as expected. Why it was not happening? Impact of COVID, income less, savings less, number one. Number two, if savings should get converted into investment, the banks should be interested. Banks should be interested in giving what? Banks should be interested in giving credit. First of all, banks under regular circumstances, when they are giving credit only, there is increase of something called as, heard of this word? NPA. I'll discuss this after 1 minute. NPA means non-performing asset. Did I discuss? No. We'll mention what it is. That means if bank is going to give loans during this point of time, there is every probability that the corporate or people like us, we may not pay it back. During COVID, I also used to get calls. Sir, please take home loan. Please take bike loan. I said, give. But don't expect. Don't expect. Why don't expect? Because I don't know when I will pay. And then if they ask, I say, RBI, I know some economics also. RBI has given some moratorium. We need not pay now. And please don't call me again. That means what? What will the bank think? this fellow is talking too much of economics. Let us not give loans to common man. Let me put this money into RBI. Better. Banks will think, if I put money into RBI, though I get less interest, it is safe. If I give money to public, there is every risk that they are not going to pay back. Therefore, they may think, why should I give credit when there is risk? Are you able to get my point? No, savings getting converted into investment will happen when banks decide to give loans. When banks decide not to give loans, or banks may decide, let me put the money into RBI, which is safer, and let me get some money in the form of interest. Monetary policy is done? No. No problem, no problem. Okay, so inflation is done, right? Yeah. So now they are putting the money back into, that means banks can put money into RBI and they can get some interest. They're getting some interest. Let's say they're getting interest of around 3.5. Okay, if you give it to public, public may pay you 7%, but still it is better that you put the money into RBI. Though banks will decide, let me put money into RBI, so automatically gap between savings and investment will decrease. This is one more. Another important challenge during COVID. This corporate, though government says, Modi ji says, don't worry, I am there for you. Madam also says, Nirmala Sitharaman Madam says, don't worry, we'll encourage startups, etc. But still, they have done something like reducing the rates like corporate tax. Corporate tax, heard of this? There's a tax which the corporates pay, don't worry about it now. Though you reduce tax rates, corporates will not be interested. They will not be interested in making investments. Why will they invest? When you know that there is a probability of making what? Loss. So they will also not take the loan. Okay, during COVID. So therefore, obviously, the gap between savings and investment is going to increase. Are you able to get this point? Everybody? Okay. So this is the reason. But India's case, if you observe, there was less gap between savings and investment. That means our investment was mainly driven by savings. This is what is the understanding. But during pandemic, this is a challenge. Today there is a question. So somebody is asking, sir, challenges of investment-led growth. The challenge of investment-led growth during pandemic is what? The challenge is savings getting converted into investment itself is a challenge. Number one. Number two, because of COVID, because of these repercussions today, what is the inflation rate today? Our inflation rate is around, inflation is around 7, isn't it? When inflation is around 7 means your savings capacity will decrease. That is also a negative or a challenge for investment-led growth. Simple words only. Inflation is increasing at a rate of 7%, which is more than the ideal rate of 4 plus or minus 2, and therefore it can act as a hindrance with respect to investment-led growth. Maybe I will write it anyhow later, but I think you're getting my point. So pick up the keywords from the newspaper. One is inflation. Another one is this challenge. Okay, and banks also will not be interested. Banks will not be interested in terms of, okay, one offbeat. Anyhow, banking I will discuss. Banking I will be taking after a few topics. Okay, so for a bank, if you know, what is the primary function of a bank? Primary function of a bank is what? It will accept what? Deposits, and it will give what? Loan. Basic. This is the main function. When bank is giving loan, it will receive what? Interest. So that is the reason loan is called as an asset for a bank. Loan is an asset. Asset is something that will give me return. So loans are assets for a bank. Okay. But what about deposits? When we deposit money in the bank, banks will pay us what? Interest. Bank will pay us interest. Deposits are our money. So deposits are seen as what? Liability. Asset, liability. Deposits are asset because this money is not bank's money. It has to be returned back. Liability. And also on those deposits, bank has to pay what? Interest. For example, a simple way to understand is, your parents may say, you are an asset today. But after 3 attempts, we thought you are an asset. Okay. We thought you are an asset, but you became. Now you find such kind of beautiful words, in civil services, what will happen is, we thought you are an asset. We sent you to Delhi also. We thought our asset will multiply, but you became, now you've got the point. That is what is NPA for a bank. So your asset, okay, for NPA is good or bad for the bank? Bad. If more NPAs are there for the bank, banks will be hesitant in terms of giving loans. No loan, no investment-led growth. Clear? Shabash. Likhoge. Nice. Understood, no? Huh. We have written that point, no? From domestic savings. Okay. Next paragraph. Factors that will determine, put the side kind of a heading kind of thing. Factors that will determine the type of growth model to be followed. Factors that will determine the type of growth model to be followed. Okay. 1. Demographics of the country. Demographics of the country. Demographics of the country. Okay. See, India's case, by 2030 and by 2040, you will have maximum what? Young population. So, the most young population means you have to create what? Jobs. So, if you have to create jobs, most importantly, which model is better for you? Investment-led growth. You allow foreign investors, etc., and there are more factories coming up. You will have more jobs that will get created. So, and also foreign investors also will come when there is young population who can work and contribute also. So, either ways, demographics of a country will decide which growth model we should follow. I think you're getting my point. 2, write down. 2, strength of the manufacturing sector. Strength of the manufacturing sector. Okay, now think of India in 1960 and 70. Okay, what were the main motorcycles or scooters we had? One is Bajaj Chetak. Bajaj Chetak, it's there? Okay, I don't know LML Vespa, it's there or not. I think it's 70s. Okay, so Bajaj Chetak is one, and later on you had Rajdoot. The vehicles were good. Yeah, the vehicles were good, but there were very few. Why? Because in the initial years, we followed something called as License Raj model. What? License Raj. License Raj is something like, for starting every company, you need to take a license. To increase the production also, you need to take a license. Okay, and one more thing is, Bajaj Chetak's maximum you can sell it to Bangladesh, or if you throw Bajaj Chetak, Sri Lanka will catch. Generally, Sri Lanka will take our, generally you will find our motorcycles running in Sri Lanka. But other than that, you cannot maximize on Bajaj Chetak. You can't sell Bajaj Chetaks to European countries. Okay, so the thing is, first of all, if you're not good in manufacturing, forget about exports. When you cannot think of exports, you cannot generally think of investment-led growth. As simple as that. So China is good in manufacturing. And that is the reason China decided earlier to focus on which model? Investment-led growth model. That means if you can focus on investment-led growth model, provided you are good with respect to your manufacturing. If you're not good with respect to your manufacturing, you cannot think of investment-led growth. You may ask a question, sir, why not? If you're good in agriculture, why can't we think? But agriculture, you know what is elastic demand, inelastic? Is it done? No. Okay. So when we talk about agriculture, Agriculture demand is there. Agriculture demand. Demand for agricultural products is there. Demand for manufacturing products is there. If our income is increasing, if my income is increasing, the proportion of demand for which products will increase? Manufacturing products will increase. For example, my income is increasing. 10,000 rupees, I am consuming 3 rotis every night. Okay, 3 rotis every night. Now, my salary became 1 lakh. Will I consume 6, 7, 8? No. So that means my demand for wheat is not in line with my income. Demand for wheat. But I want a better motorcycle. I want a better iPad. I want a better laptop. That means demand for these manufacturing goods is increasing with income. Are you able to get my point? But demand for primary products is not in line with my increase in income. This is the biggest challenge actually. If you're good in agriculture also, you cannot maximize it. You cannot maximize it because there is a limit to it. Are you able to get my point? It is basically need base. Need base. I think you're getting my point. So therefore, the biggest challenge is, if you're good in agriculture also, you cannot maximize on your agricultural exports. Beyond a level, LDCs, least developed countries, cannot maximize on agricultural exports. You cannot occupy global market with your agricultural products. Are you able to get this? Because first thing, they will also they will have their own agricultural production. It can be replicated easily. But if US is pushing its iPads into India, is there a replication for iPad in India? We are still with carbon. Accept it. We don't have a tab which will compete with iPad. I think you're getting my point, right? So this is the biggest challenge. I think that is why manufacturing. That is why I've written manufacturing. I have not written agriculture here. Clear? Yes. Next point. Openness of economy. Openness of economy. How open the economy is. Openness of economy. That openness of economy, India was more of a closed economy earlier, remember? Today, so for exports, you need to be more of a open economy, as simple as that. Next, write down. Trade balance. Trade balance and economic strength of the country. Trade balance and economic strength of the country. Trade balance means a deficit balance. Trade balance and economic strength of the country. Okay. Then one more point there. Consumer behavior. Consumer behavior. Okay. Consumer behavior. I think I would have asked you this question earlier also. If you want to produce products, is it better to produce for the rich or middle class? Did I ask this question? Not this class. Okay. I'll tell you one concept here now. See why consumer behavior. Consumer behavior, see if you talk about consumer behavior, foreign players or you find KFC, don't think KFC chicken is one of the best chickens. It's not the best chicken, it's one of the hopeless chicken. Okay, and it looks fresh, it is not fresh. Now listen very carefully, I'm making some statements here. So better before eating KFC, be careful. But still, these companies will come into India, McDonald's, provided consumer behavior is to spend more. Earlier years, though money is there, for example, if I take my grandfather to a movie, now when I buy popcorn paying 550, 650, actually I go to a movie for popcorn or eat something, not for the movie. But they say, what are you doing? Okay, the logic here is consumer behavior plays an important role, and middle class, especially the increase in middle class will have a direct impact on demand. Suppose, I'll ask you a question. First of all, what is economies of scale? What is economies of scale? If I'm a very big, large company like Walmart, if I am producing on a mass scale, I will procure raw material also in bulk. Bulk procurement will be there. When I procure raw material in bulk, my cost per unit will be less, and therefore I can offer better discounts. Are you able to get this point? Amazon can offer better discounts. Walmart can offer better discounts. Walmart can offer better discounts because of economies of scale. Economies of scale because their cost of production will be less because they are buying raw materials in bulk. Okay, this is clear, right? Now, if you want to produce, suppose you decided to come up with a startup, you will produce products for the rich, or you will be interested in producing products for the middle class, or will you be interested in producing products for the poor? सोच के बताओ. नहीं, हाँ, middle class. You will produce for middle class. Rich, poor, no. Poor, not interested. Okay. See here. Think very properly. For the rich, okay. When we talk about demand, did you discuss demand graph or something? No. Yes, demand. Okay. For the rich people, if there is a change with respect to prices of products, change with respect to prices of products, will it have more impact on the change in demand or less impact? Less impact. Ambani madam, rice price increased, petrol price increased, diesel price increased, car price increased. Will she be worried? Oh, Ambani madam, huh? Ambani may be worried. Because he is putting in effort. Madam is also putting effort, no doubt, but madam is spending well. Okay, so madam doesn't know in which vehicle she is going to travel today. It just comes and she moves. Okay, yes. Listen very carefully. I have a point to make here. The prices change will not have much impact on madam's purchasing level. That means the demand she can create, the impact is very minimum. She's least bothered with respect to prices unless and until it is prices of Reliance, because the company she wants to look into. Okay, clear that. Right? That means rich people generally have a kind of demand which I will call it as inelastic. Inelastic means something like there is a change in price, but the impact of change, whether it is increase, whether it is decrease, the impact of that change is very limited with respect to what? Demand. Demand will not change much, no. Price increases, price decreases. She will buy what she wants to buy. Are you able to get my point? Okay. Then what about poor? How about poor then? What do you think? Elastic, inelastic? No. Poor people, 90% of their income they spend on necessity. Food, small liquor. That's all. Necessity. This is also necessity. See, now just observe a poor man's lifestyle. But 90% is on necessity. When I say necessity, necessities have elastic or inelastic demand? Inelastic. Necessities means what will happen? Necessities generally, I will buy, that's all. Slight increase in salt price, I'll not stop buying salt. Slight decrease in salt price, it's not that I'll eat more salt. So generally, it will be inelastic. Are you able to get my point? Okay, so even for the poor man, it will be inelastic. Now, you said inelastic. You said you will manufacture products for whom? Middle class. Middle class, you said, no? You said you'll manufacture. Middle class is somebody who is price sensitive. If you ask him to pay 1 rupee more for vitamin D fortified milk, he will say, Ramdev Baba told, stand in sunlight. Baba told, stand in sunlight, you will get vitamin D. 1 rupee more, I will not pay for your vitamin D fortified milk. That means middle class is price sensitive. Middle class is price sensitive. They have elastic demand. Little price you increase, they will show you what they can do. Okay, suppose airfare is increasing, they'll say we will go in train. The traffic which I have who are traveling in Indigo, SpiceJet, they are not real flight passengers. They are train passengers who got shifted. Now suddenly you increase the price. You say, time is not important. We will travel, don't worry, we'll enjoy the train journey. Okay, now the thing is slight increase in, that means middle class, generally they will show what demand? Price, small price change. And and who is targeting them? Who is targeting them? Amazon. Amazon is playing here. If you will play here, now you may say, sir, I will compete with Amazon. Where there is a will, there is a way. All that is nonsense. That will not work. You cannot compete with Amazon. You will die. You will die. Not Amazon, you will die. Okay, so here basically you cannot produce. Now more is the middle class population. More would be the bigger companies which are price competitive, which can come into India and grab the markets. Indian middle class is increasing. Indian consumer behavior is changing. Therefore, companies like Amazon, therefore companies like Walmart want to enter India. Shift in behavior, number one. Two, economies of scale. They can target this segment. Smaller player cannot target here. Smaller players it becomes because price sensitivity. IIM grads have started a supermarket called Subiksha. I still know during our MBA period. Subiksha is one of the very good supermarket which used to give super discounts for every product. But what happened was, wherever Subiksha was there, Reliance started its Reliance Fresh. And they said, buy one, get one free. And today you don't find Subiksha. So middle class segment, smaller pockets, you cannot target. I think you got my point. So shift of consumer behavior, increase in middle class also plays an important role with respect to investment, foreign investment moving into the country. Today malls are there. Why? Because you go and spend unnecessarily. Okay, so yes, making it a point there. Got the point right. You have understood now. Very good. Next heading, reasons for China's shift. Reasons for China's shift. Reasons for China's shift. Actually, China wanted to shift. Huh? Again, I'm making it a point. Okay, just write down. Reasons for China's shift to consumption-led growth. Reasons for China's shift to consumption-led growth. Okay. See, China wanted to shift, but even today, China did not shift. That is something which you should remember. Okay, one, write down. One. Subprime crisis. S-U-B. Subprime crisis. Huh. Yes, yes. Prime only. Not Amazon Prime. So, subprime, subprime crisis, subprime. Okay, this is a financial crisis, financial crisis where in US. This is somewhere in 2008, subprime crisis. In US it was a financial crisis. Of course, I'll not get into too much of detail. Financial crisis was in US because there was a collapse of the banking system in US. That much only today. Okay, banking system in US, and there was a financial crisis in US. Okay, when the 2008, there was this financial crisis. After this, US started closing its economy. Closing means what? US started, not just US, European countries also, they started following something called as protectionism. When you follow protectionism, what will get affected? Exports. So China exports were getting affected, and therefore China decided it will shift to what? Rather than, it was thinking to shift to focusing on its domestic consumption. That is the meaning. Write down. Subprime crisis. You're able to follow now? Yes. Subprime crisis and impact on external trade of the country. Impact on external trade of the country. Two, protectionist policies and move towards deglobalization. Protectionist policies and move towards deglobalization. Deglobalization. Everybody knows globalization? Okay, globalization means you're opening up your market for foreign. Uh, Not just trade. See, globalization means free movement of capital, free movement of goods and services, free movement of labor. All this is globalization. I'll talk about it in 1990. That is the 8th five-year plan. That is what is globalization. Deglobalization means reverse. Deglobalization. I'm using the word D. Deglobalization means it is reverse. Means you are trying to close your economy. You're going back to the earlier models of protectionism. Deglobalization, you're trying to close your economy. That is what is deglobalization. Okay, next point. Lack of markets for Chinese goods. Lack of markets. Lack of market for Chinese goods. Okay, China was slowly losing its relevance. China means cheap. That image was going. C, both C. China cheap. Okay, so like that the image was spreading. And therefore automatically what was happening? Some demand was falling. Next point, write down. Changes in consumer attitude and technology. Changes in consumer attitude and technology. Changes in consumer attitude and technology. Okay. Then last point. Aging population and change in demands. Aging population and change in demands. See, if you know, foreign companies, why were they going to China? Because cheap labor was there. Now, aging population means labor will become what? Costly. That advantage of cheap labor is going off. And therefore, foreign companies also will be hesitant. I think you got my point, right? Next. Got it? Next side heading, write down. Reasons for India's shift. Reasons for India's shift. Reasons for India's shift to investment-led growth. Reasons for India's shift to investment-led growth. Okay, write down 1. Huge demographic dividend. Huge demographic dividend. Huge demographic dividend. Okay. 2. Aim of emerging as industrialized country. Aim of emerging as an industrialized country. Aim of emerging as an industrialized country. To handle industrialization 4. To handle industrialization 4. To handle industrialization 4. See, industrialization 4 basically deals with, industrialization 4 means it basically deals with, remember, it basically deals with artificial intelligence and robotics. Artificial intelligence and robotics. Are you able to get this? Okay, so tomorrow what will happen is, in future, there will be replacement of jobs. In future, there will be replacement of jobs. Where? Jobs in India and China. See, earlier industrialization, whoever has handled it better, they are the developed countries today, steam engines, etc. Today, industrialization 4, if you are silent, you are not able to adapt to industrialization 4. You are not able to adapt to industrialization 4 or artificial intelligence means there will be huge losses in the jobs and there will be a problem. So India should become an industrialized country. India should focus on research and development, etc. Because before this wave of industrialization 4 or artificial intelligence takes things away. Are you able to get my point? So India wants to become for which you need foreign investment. For which you need foreign investment, for which you have to follow something like investment-led growth model. That is the meaning. Next point, write down. To attract more foreign investment, in the form of, to attract more foreign investment in the form of FDI, in the form of FDI and FII. FDI means foreign direct investment. Foreign direct investment. FII means foreign institutional investment. FII means foreign institutional investment. Foreign direct investment, foreign institutional investment. Or indirectly I say more, we need more of what? Foreign investment. Now one small question. What is the basic difference between both? Okay. Basic,
FDI is the investment in the companies more than 10% or in the for long term.
Okay.
And FII is the investment in the shares.
Okay. He has come up with the latest definition of FDI. But what I will only stick to the basic definition. Okay, latest definition is okay. See, what is foreign direct investment? See, foreign investment is coming into India. Foreign investment is coming into India with the intention of doing business in India. Mainly. I'm talking about the basic. The investment is coming into India with the intention of doing business. Business can be greenfield. Greenfield means you're starting the business from the beginning. That is called greenfield. Or you're investing in an existing business. Already there is a business and you want to revive it. Whatever it is, the intention is to do business in India. Are you able to get this? Foreign investment moving into the country with the intention of doing business in India. Is this clear? So they are coming in to do business in India. Okay. And along with that, when they move into the country, they will also bring in their technology. They are coming into India to do business means they'll bring in modern technology, number one. And they are creating jobs. You're setting up factories, etc. Means in India, there will be creation of what? Jobs. Are you able to get this? And this FDI will also definitely enhance our what? GDP, no doubt about it. Okay. So, or there can be some foreign companies which can start their subsidiary firms. For example, Citibank US wants to come up and start Citibank India. They want to set up their subsidiary companies. All that is also what? FDI. This is a basic English definition. Of course, what he says is a little above thing, which we will talk about it later, 10%, etc. Till here, is it clear? So investment is coming in with the intention of doing business, number one, or coming up with a subsidiary firm. Subsidiary means already existing company is there. You're coming up with Citibank US, Citibank India, or you're acquiring an existing company. Already there's a company like Ranbaxy, which is taken over by some other company, but intention is to do business. So they will bring in their modern technology along with them, and it will also lead to creation of what? Jobs. Okay, that is the basic understanding of FDI. Basic understanding is okay. Okay, that in a different color. Now FII is what? Foreign institutional investment. Now this money generally goes into the this money will generally go, it will generally get into the share market, or this money will generally get into the stocks. Okay. In India, who will regulate shares? There is a regulatory body. Shares are regulated by an institution. There is one institution called Security Exchange Board of India. I am repeating it. Security Exchange Board of India regulates share markets or regulates these investments. Now what happens is, you will have certain institutions which are there, some foreign institutions, like let's say there is a foreign institution like the Morgan Stanley. It is one institution, nothing great, one institution which is there. This institution has already taken license to operate in India. License, you need a license to operate in India. So this Morgan Stanley has taken a license to operate in India, and you have different foreign investors who want to invest. Where they want to invest? They want to invest in the Indian stock market, Indian share market. Okay, they want to invest. So if you want to invest in the Indian share market, you have to submit your details. All the details have to be submitted to SEBI. Otherwise you cannot invest. That means there will be some KYC kind of thing like a bank. Okay, so all the details Morgan Stanley will be submitting. Morgan Stanley will be submitting their details to SEBI and take approvals. And through this institution called Morgan Stanley, these investors are going to invest into Indian stock market. Are you able to get this? Through this institution called Morgan Stanley, foreign institution, they are investing into Indian stock market. Are you able to get this point? So therefore, we are using the word foreign institutional investment. Why institutional investment? Because the investor is investing through an institution. Are you able to get this? Okay. So these investors can either invest into shares, or they can either invest into bonds also. Okay. Now if you don't know this, leave it. After 5-10 minutes, I will discuss again. Okay. So, but you're able to understand the difference. Now, what is the benefit of FII for us? The company, this company, Indian company, if he's buying some shares, it is able to raise money, this Indian company is able to raise what? Capital for business. Why will a company issue shares? LIC recently issued something called as IPO. IPO is initial public offering. First time LIC has issued shares. First time LIC. All of us can buy. Public means all of us can buy. Okay, we have applied. Okay, all of us can buy. Now the question is, what is the benefit for LIC? LIC is raising what? Money or capital. Simple logic. Same. This fellow is investing, foreign entities are investing, means they will raise what? Capital. I think you're getting my point. This is the basic difference between the word FDI, only the word FDI and FI. Later again. So it is outside, but it has come up in our discussion, and therefore this explanation. There only, if you want, you can just mention the words foreign direct investment, foreign institutional investment. This is long term, this is short term. Short term, why? Whenever they want, they will sell the shares and go back. See, something wrong happens, no? In India, suppose Kasab and friends have attacked India. Kasab and friends have come immediately. When something like that happens, these FIs, they will sell the shares, they will go back to their country. That is why financial capital is attacked. Are you able to get my point? Okay, so is this clear? Yes. Okay. Now, done. That is done. Right? This is why India wants to shift, why China wants to shift. Hope it is clear. Okay. Now, before I can analyze the negatives or the challenges of investment-led growth, okay, 1 or 2 points we can add up only after we discuss Harrod-Dormer model. Okay, 1 or 2 points we can add up only after we discuss Harrod-Dormer. But now, as of now, can you tell me some points, or what are the challenges with respect to implement. I'll fill it up after Harrod-Dormer, but now you'll tell me presently, on date, like today. See, what will happen is, we can write few points only after certain chapters are over for you. For example, monetary policy is there. Like this, there are some chapters. But as of now, from your knowledge, you should think and tell me what are the challenges in implementing investment-led growth model today. Okay. I will write from the basic. Okay, challenges. First challenge is what? Inflation. Inflation is increasing, thereby reducing my propensity, reducing the propensity to save. Actually, this can become better afterwards, but still. Okay, that is one. Yes. Then, demographic dividend skill. Okay. Rise in interest rates. Okay. So today we find that banks' interest rates, monetary policy is not done. Therefore, I'm writing the word interest rates. Today you are finding what? On date you're finding our interest rates are increasing. Why our interest rates are increasing? Okay. That inflation topic is done, no? Okay. So interest rates are increasing to control what? Inflation. Very good. Interest rates are increasing to control inflation. Okay. Now the question is, really by increasing interest rates, can we control inflation? Some extent means what extent? Huh. Yeah. Okay. Okay. Very good. You have discussed this word in inflation? Okay. Demand pull inflation. Right, right. So what he's saying is that RBI can handle which inflation better? RBI can handle which inflation better? Demand pull inflation. RBI can handle. Why? How do you handle demand pull inflation? By increasing interest rate. If you increase interest rate, loans will become costly. My home loan will become costly. My car loan will become costly. Everything will become costly. Are you able to get this? So that means the demand in the market will decrease. What is demand pull inflation? Too much of money is chasing too few goods. Too much of money is chasing too few goods. That is what is demand pull. So to handle demand pull, this too much of money which is there, I have to reduce it. Are you able to get this? How do you reduce it? One way they were thinking is, okay, interest rate. Okay. Now, did you discuss something like CPI? CPI, Consumer Price Index. In this Consumer Price Index, maximum weightage is for food items, right? Maximum weightage is for food items. But today, the challenge is we are also facing inflation with respect to cost push, and you also find that we have a challenge with respect to this inflation called what? Food inflation. Food inflation. Okay. Now, RBI's policy cannot do much with respect to food inflation. That means RBI may handle demand pull, but RBI cannot handle oil prices. RBI, because oil prices are dependent on barrel prices. Oil prices are dependent on our fantastic tax policies, okay, with respect to petrol, diesel. And oil prices are also dependent on, okay, so multiple factors. Along with that, food prices are dependent on monsoon. Yes, supply chain problems. Okay, supply chain problems, warehouses. Okay, so all that. So this cannot be handled. This cannot be handled. So inflation also is a challenge now. Okay, and one more challenge is in US. Now observe very carefully. In US, interest rates. In US, inflation is how much? Around 9%. So what will US think, to increase interest rates or decrease interest rates? Huh? Same, no. When we have inflation, we are increasing interest rate. When they have inflation, they will also increase interest rate. Are you able to get my point? Okay. So in US, if there is inflation, they will increase interest rate. Means what will happen to dollar supply? Dollar supply. That means money supply. Same. Rupee supply here. There it is dollar supply. So money supply in US or dollar supply in US, will it increase or decrease? Decrease. Are you able to get this? Dollar supply in US will decrease. Okay, no? If dollar supply is less, what will happen to demand? Demand. See, always in economics and in life, everything, almost everything, is demand and supply. Almost everything is demand and supply, including the demand for IAS officers, including engineers. Are they in demand today? No. Why? Every house has an engineer. Supply is more. Are you able to get this point? No. Same IAS, demand is more because supply is less. As simple as that. Now dollar has become stronger. Dollar demand will be more because supply is not there. Means what will happen to dollar? Dollar will become strong or weak? Dollar will become strong. Yes or no? If dollar becomes strong in comparison to dollar, what will happen to rupee? Rupee will become weak or strong now? Rupee will become weak. Everybody, weak. Rupee will become weaker in terms of dollar. That means everybody is able to follow. Now suppose $1 is 77. I know, wait. 78, 79, 79.2, I know. Wait. Now suppose $1 becomes 80. 3 days back it was 80. Okay, so $1 becomes 80. Now that means what has happened to rupee value? Rupee value has decreased. To buy the dollar you are spending 77. To buy the same dollar you are spending how much now? 80. Are you able to get this? Means dollar became strong. Whenever dollar becomes stronger, rupee will become what? Weaker. Now everybody, is this clear? Now dollar is becoming stronger. Why dollar is becoming stronger? See, this is the reason. Interest rate. So when rupee becomes weak, now what you should understand is, when rupee becomes weaker, okay, what will happen to our imports? Wait, what will happen to our imports if rupee becomes weak? Okay, if you don't know, I will explain with an example. Rupee becomes weaker, import will become what? Costly. Is it, you know this? Is it done? Very sharp class, huh? You know everything. Now the question is, I will just explain with an example. Now what I wanted to say is, I am buying this pen from US. Let's understand this. This pen is 100 rupees. I am buying from US, 100 rupees. Example, or let's say this pen is $1, okay? And I'm buying from US. 2 cases I'm taking, observe very carefully. First case, $1 is 50. Second case, $1 is 100. Okay. I am buying this pen. In the first case, how much I have to pay? 50 rupees I have to convert into $1 and make my payment. Second case, 100 rupees I have to convert into $1 and make payment. Everybody? So my import, when I'm importing this pen, my import is becoming costly in which case? In the second case. My import will become costly in the second case. That means if my rupee value goes down, my oil import, which I'm importing today, will become what? Even more costly. That means this will also again lead to what problem? This will again lead to the problem of inflation, and this inflation also RBI cannot handle. Now, are you able to follow? Anywhere you are not able to follow, you stop me, I'll explain again. So this inflation also RBI cannot handle, but why is RBI thinking of increasing the interest rates? Now the question is, when RBI is not able to handle food inflation or oil inflation, then what is the fun in RBI increasing interest rate? If RBI reduces interest rates, RBI focuses on reducing interest rates, so the banks reduce interest rate, that means what will happen to rupee supply if interest rates are less? If interest rates are less means rupee supply will increase. Are you able to get this point? Okay, rupee supply, if RBI now, instead of increasing interest, if they reduce interest, means more rupees in the market. More rupees means rupee supply will be more. More rupee supply means rupee will become stronger or weaker? Weaker. More rupees, anything more, weak. Rupee supply is more means rupee will become even more weaker. If rupee becomes even more weaker means my rupee value will go even down, because of which my oil will become even more costly. Are you able to? See, what I was trying to say is, RBI is able to handle only demand pull inflation. RBI is not able to handle cost push. Demand pull means what? Too much of money is there, you are reducing it. But if you are not able to handle cost push, and 45%, around 45% of CPI which you know, inflation, is food, and RBI cannot handle food inflation. Food inflation is not because of demand, etc. There are many problems in food inflation, oil inflation. Then why is it that they are increasing the interest rates, is the question. This is because US is also focused on increasing their interest rate. Are you able to get this? This is because US is also focused on increasing their interest rate. Because US is increasing interest rate, dollar is becoming what? Strong. US is increasing interest rate, dollar is becoming stronger. Why? Interest rate more means no dollars. No dollar means dollar strong. Dollar strong means in comparison to dollar, rupee will become weak. Till there everybody has understood? Okay. Rupee is becoming weaker. Rupee is weak. Rupee is weak means import will become costly. Import is costly means oil is costly. Food import will become costly means it will lead to what? Inflation. Now, if in India, if rupee supply is also more, that means interest rate is less and more rupees are available in India. If rupee supply is more in India, more rupees are there, means rupee will become even more weaker. More supply means less, more weak. More supply means less demand. Are you able to get my point? No. Anything in abundance, no value. Rupee more, less value for rupee. Dollar more, less value for dollar. Keep that logic in mind. So more rupees in the market means, if interest rate is less, more rupees in the market. More rupees in the market means rupee will become even more weaker. If rupee becomes even more weaker, imports will become even more costly, means oil and food will become even more costly. That is the reason. That means here, okay. So one more challenge for, if you have understood this, okay. If you have not understood also again later, I think base inflation is so clear. Okay, so now what you should understand is, if, here the logic is, if interest rates are increasing, this is also a challenge for our, challenge for what? Challenge for investment-led growth. That is what you should understand. It's a challenge for investment-led growth. Which one? High interest rates. And one more challenge for investment-led growth. One more challenge for investment-led growth. Okay, anybody? From what you know, what are the other challenges for investment-led growth? No licensing, don't think of license. Foreign policy, okay. Vulnerable, okay. Foreign crisis now? Okay. This is a known problem. Okay. So, globe is not doing well after COVID, and therefore, you should write it like this. The globe is moving towards deglobalization, thereby affecting what? Thereby affecting what? Exports. Thereby affecting exports. Stick to the what we have discussed only. Okay. Stick to what we have discussed only. Then anything else, like yes, from the keywords. Okay. So, it will affect. If protectionism also, interest rates also, inflation also, then, okay. Another problem is, there is a challenge of increase with respect to NPAs in the banking system. Think of only base words. NPA, more NPA means there will be a challenge of banks giving loans, challenge of banks giving credit, challenge of banks giving loan. So more NPAs, less loan availability, less credit, less investment-led growth. Are you able to get this? Then another challenge is, this investment-led growth will happen only if there is sufficient public investment. Only if, when there is sufficient public investment. Public investment means what? Whose investment? Government investment. In government investment in what? Government investment in infrastructure. Very important. That is the reason budget is completely focused on this point, that public investment will drive growth. They did not say in the budget private investment as in 2018. This budget they were saying public investment will drive growth, means public investment into what? Public investment into infrastructure. More road, port connectivity, more infrastructure, then only there is a possibility of this model called investment-led growth. Is that clear till here? Okay, so I'll rub this off. Is this okay till here? Okay, so public investment or infrastructure is also one more point which you should know. Okay, then Okay, so there is one point which I am writing. I will discuss this after the Harrod-Domar model. Okay, after the Harrod-Domar model, that is, India has high capital output ratio. This I am putting in bracket. I'll discuss. So therefore, this I will discuss after 5 minutes. Harrod-Domar, then you will understand. Other words are okay. So I've written what? COR. COR means capital output ratio. This is the only word which we have not discussed till, but this is also a reason for a negative. It is a negative for our investment-led growth model. High capital. I've written high. High capital output ratio. High capital output ratio in India. High capital output ratio in India. Okay. What are the challenges for investment-led growth is, during COVID, private players have pushed off employees. Are you able to get this? Private players have pushed off employees completely. This is a very big challenge because of that, job market also has got affected. That is the reason government decided we should do something with respect to public investment. So now the challenge is for the government, how the government will balance between, one is infrastructure on one side, on the other side government also has to balance what? Welfare. Now, because any time whenever there is pandemic, the biggest problem or a dilemma for a government will be, how do I balance? So the balance or the challenge of balancing between infrastructure on one side, how do you balance this infrastructure? On the other side, how do you spend money for MGNREGS, or how do you spend money for schemes and these kind of things? Why government should spend money on schemes? Because during COVID pandemic, most of the private players have kicked the employees off and most of them have lost their jobs, and this is the biggest challenge for the government, and government is not in a position to create so many jobs also. Government is not in a position to create so many jobs, and moreover government has to, another important challenge for the government is, because of COVID, government had to borrow more. Borrow means what? Government's debt has increased. Are you able to get this point? See, whenever debt is going to increase, what is the meaning of debt? Government has borrowed more means government has to pay it back. More is the debt, you have to pay that back. When you're paying it back, you will have less resources to spend on infrastructure. Obviously, when you borrow more, your hands are tied in terms of spending money on something like infrastructure. Is this clear? Okay, so you should think from the present context, but I will make you write this topic after I discuss Harrod-Domar. Is that okay? I think that is a better way, or you want to write it now? You write it now? Okay, then put the heading, write down. Your wish. Challenges of investment-led growth model. Likho. Challenges of investment-led growth model. That is why we are writing now. Challenges of investment-led. Avi likho. Challenges of investment-led growth. Okay. One. Okay. 1. Inflation. High inflation rate of 7% plus. High inflation rate of 7% plus will negatively affect people's propensity to save. People's propensity to save will negatively affect people's propensity to save, thereby affecting investment. 2. Foreign investors will be hesitant to invest. foreign investors will be hesitant to invest due to uncertain market conditions. Due to uncertain market conditions. Due to uncertain market conditions and fall in consumption. And fall in consumption. Jobs lost means consumption will be less, so they will think twice to invest. Okay, that is a point. Okay, 2. Write down. 3. Internet is okay. What is? No, windfall gain tax. Why now that? We'll discuss that later. See, windfall gains, we'll discuss windfall gains when you're discussing national income, etc. For example, there are taxes on some things like lotteries, betting, etc. Lottery, betting, gambling, etc. Okay, so there are issues with respect to exceptions. There we discuss windfall gain taxes, etc. We'll discuss in taxing, not now. Huh? We can? Somebody? Huh. Investment led growth. हाँ बताएंगे. That we will do. First let's write this and then. Okay. Inflation we have written. And then we have written what? Foreign. हाँ. Write down the third point. Third point. In India, we have high capital output ratios. In India, we have high capital output ratios. High capital output ratios, which will adversely affect investment, and GDP growth. Okay, so this I will make you write and discuss after some time. Okay, that is about capital output ratio. Okay, leave that. Next point. Problems of twin balance sheet syndrome. Problems of twin balance sheet syndrome. Problems of twin balance sheet syndrome. Okay. Problems of twin balance sheet syndrome. Twin balance sheet syndrome. TBS. Twin balance sheet syndrome. Very simple only. On one side, you have banks. On the other side, same NPA only, we are writing it in a different format, that's all. On the other side, you have corporates. Whenever the economies are not doing well, what will happen is people like Vijay Mallya, people like Nirav Modi, okay, they will not pay the loans to the bank. If you observe, government banks, they will not give loans to us, but they will give loans to Nirav Modi and Vijay Mallya. Most of this, if you observe, Vijay Mallya also, or Nirav Modi, Punjab National Bank, almost all of them are government banks. Are you getting my point? So here, corporates are not paying the loan to the bank, means what will happen to the bank? Bank's balance sheet is going to get affected. Therefore, what will bank do? Bank will not, balance sheet is getting affected, means for the banks, what is increasing? NPAs are increasing. Therefore, bank will not give what? Easy loan to the corporates. That means, one's balance sheet is affecting the other's balance sheet. Corporate balance sheet will affect the bank's balance sheet. Bank's balance sheet will affect the Corporate balance sheet. If corporate is not doing well because of COVID or whatever reason, he will not pay back the loan to the bank. So bank's balance sheet is getting affected. If bank's balance sheet gets affected, banks will not give easy loans to the corporate. If banks do not give easy loans to the corporate, then automatically what the challenge will be with respect to implementing this model called investment-led growth. Are you able to get this? Okay, so that is the point we have written. Everybody has understood twin balance sheet syndrome. Okay, so in bracket you can write bank's balance sheet affecting corporate balance sheet and vice versa. Bank's balance sheet affecting corporate's balance sheet and vice versa. Either ways, it's basically. Okay. Next point. Is that okay? Why? Okay. Next point. Write down. Issues of currency war. And protectionism. May affect India's exports. Okay. Now what is currency war? Okay. So, see, here everybody knows, like, listen very carefully. $1, let's say we have discussed this just now. Okay, said $1 is equal to, okay, 79, or $1 is 80, okay, or $1 tomorrow if it is 100, whatever it is. This is the exchange. This is basically because of what? Because of what? Market. What is market? Market is nothing but forces of demand and supply. This $1 is 80 or $1 is 79 because of the logic of demand and supply. So that means $1 is becoming 80, $1 is becoming 100. You call it as something like, we use that rupee value has depreciated. Everybody knows this word? See, depreciated or depreciation. That means $1 is 80. Tomorrow $1 became 100 means what? Rupee value has depreciated. And dollar value has appreciated. Are you able to get this? In simple words, dollar value has increased, rupee value has decreased. Or decrease means depreciation, increase means appreciation. Everybody has understood this? Now the question is, instead of market, if the government itself decides, instead of market, if tomorrow in China it used to happen, so they directly say tomorrow, let's say one fine morning now government says, Modi ji and RBI together, they decide from today $1 we are putting it as 100, irrespective of market. $1 is 100. That means we are wantedly reducing the value of currency, of Indian rupee. This is called as what? Devaluation. The simple word called devaluation. Here depreciation is happening because of what? Market. Here devaluation means one fine morning, 1966, for the first time, India devalued its currency. 1966, for the first time. In the planning I will discuss, 1966, India devalued its currency. Why will they devalue? China used to devalue its currency. Why China used to devalue its currency? Because if you devalue currency, devaluation of currency will make your exports what? Cheaper. See, devalue your currency. Suppose, अभी देखो $1 is 50 in one case, $1 is 100 in the second case. And this pen is costing 100 rupees in India. And I am exporting this pen to US. Okay, in the first case, when I'm exporting, they'll pay me how much? 100 rupees means pen cost is 100, $1 is 50. Okay, they have to pay me 100 rupees, right? They have to pay me 100 rupees when $1 is 50 means they have to pay me how much? $2. Because pen cost is how much? 100. In the second case, same pen cost is 100 only, but $1 is also 100. Now they will pay me how much? $1. That means in the second case, what has happened to my exports? My exports have become what? Cheaper. It is good in the sense I'll be able to grab global markets because my exports are becoming more competitive. More competitive. Devaluation will make exports what? Cheaper. Okay. Devaluation, everybody's understood or you want me to repeat? Is it okay? Devaluation will make exports cheaper. Now the challenge is, currency war means, currency war. I've written a word called currency war. There, that is what I've done there, currency war. Currency war means China has devalued. Okay. Seeing China, Japan has devalued. Seeing Japan, South Korea has devalued. Like this, if countries are trying to devalue their currency, they are trying to make their exports what? Cheaper. This is called as currency war. Currency war means, there you just mention currency war, competitive devaluation. Write down. Currency war. Currency war. There you just mention currency war. Competitive devaluation of currencies. Competitive devaluation of currencies. Competitive devaluation of currencies to make exports cheaper. To make exports cheaper. Are you able to get my point? Now, why this is a challenge for India? When other countries are fighting like dogs by devaluing their currency and making exports cheaper, now how will you compete in the international market with respect to your exports? Are you able to get my point? Okay, so that means if there is currency war, exports will become what? Cheaper. China or these countries. So it will become difficult for us to maximize on our exports. It will become difficult for us to maximize on our exports. Everybody is understood? Yeah. Willing. No, devaluation is willing. It is purely willing. China was wantedly reducing the value of its currency to make its exports cheap and grab global markets. That is okay. That is at least, but that is based on market, no? No. When it is because of market, it is not currency war. If the government decides to reduce the value, then it is currency war. Are you able to get this? Got the difference? No? Yeah.
So the devaluation of currency knowingly is same as currency manipulation?
A kind of currency manipulation, yes. That means you're not leaving things to the market. China and US were fighting because China was more into determining its currency value according to its own standards. Understood? No. So China was, because Chinese economy was run based on exports, China was wantedly devaluing its currency to make their exports cheaper and flood global markets with cheap Chinese goods. And this was affecting other countries' markets, and therefore there were a lot of discussions asking China to determine their currency value based on markets, not by your government. You should determine your currency value based on market fundamentals. Only if there is a necessity, like after 1991 we did it once. 1966 we also devalued once. There is a logic for that. But now we are leaving things to the market. Okay, we are leaving things to the market. It's not that RBI will only interfere under critical circumstances. RBI will not interfere every now and then in India's currency determination. RBI will not interfere. RBI has left things to the market. If there is a challenge, if there is a problem, then only RBI will come. I think you got my point, right? So more currency wars, more protectionism means it is a bigger challenge for India to maximize on their exports. Maximize on their exports. Why they are protecting their market? and there is currency war also, then automatically our exports are going to get affected. If exports get affected, there will be a big challenge with respect to investment-led growth model. Clear? Okay. Next point. Clear? Investment-led growth model will be successful. Write down. Investment-led growth model will be successful only if there is sufficient public investment. Only if there is sufficient public investment. Only if there is sufficient public investment into infrastructure. Into infrastructure. That is, infrastructure is a prerequisite. That is, infrastructure is a prerequisite for investment-led growth model. Infrastructure is a prerequisite for investment-led growth model. Is this clear there? Okay. Next point. Okay. Next point, write down. Investment-led growth model may land up. Investment-led growth model may land up. Replacing labor. Replacing labor if it turns out to become capital intensive. If it turns out to become capital intensive. Okay, next point. Due to increase in debt burden of the government, due to increase in debt burden of the government, in bracket, fiscal deficit, in bracket, fiscal deficit. Did I explain this word earlier? Okay. Huh? No. Okay. हाँ ठीक है. Okay. Fiscal deficit. It may lead to crowding out. Write down. It may lead to crowding out private investment. It may lead to crowding out private investment. It may lead to crowding out private investment. Okay. I'll explain after 2 minutes. One more point. Governments generally face dilemmas. Governments generally face dilemmas to balance welfare along with capital expenditure. To balance welfare along with capital expenditure. Okay, stop there. Okay, now see here. This is something like you will be writing the definitions of fiscal deficit or capital expenditure in the budget class. Listen very carefully. This is a little offbeat. Okay, so these things you will be writing in the budget class. Okay, but I will only be just telling you so that you'll not have any problem in understanding the word. I'm not going to derive the formula. Okay, that will be done in the budget class. Okay, so I'll just explain the term, what is fiscal deficit. Okay, so let's try to understand. Huh. See here. Okay, the word first of all is, you should know what is fiscal policy. Fiscal policy. Okay. So fiscal policy of the government is that policy. Listen very carefully. Very simple only. Fiscal policy of the government is that policy that deals with the incoming money that is coming into government's pocket, and also it also deals with the outgoing money that is moving out of government's pocket. To be very specific, very basic, incoming money moving into government's pocket, outgoing money moving out of government's pocket. Okay, policy of the government. Simply, for this fiscal policy, indirectly we use the word also like budget or the annual financial statement. Okay, so now when I use the word incoming money that is moving into government's pocket, incoming money that is moving into government's pocket, we use the words like revenue, or we also use the word like receipts. Money is moving in. Both are not identical. There is slight difference also. There is slight difference between revenue and receipts also. I'll talk about it. Outgoing money, we generally use the word called expenditure, or I will be using the word like payments. Expenditure or payments. Okay. Now see here, when I talk about this word revenue, when I talk about this word revenue, revenue. Okay. In the inner circle, I have put the word revenue. In the outer circle, I have put the word receipts. Okay. Inner circle revenue, outer circle receipts. Whatever is moving in into government's pocket, it can be treated as receipts. Whatever is moving in into government's pocket, it can be treated as receipts. But all receipts need not be revenue. All receipts need not be revenue. Are you able to follow? All receipts need not be revenue. That means every incoming money into government's pocket need not be revenue. That is what I mean. Every incoming money that is coming into government's pocket need not be revenue. Are you able to get this? For example, when I use the word tax received by the government, tax is something like revenue for the government. Revenue. Government is collecting tax. It's government's money. Government is getting this tax. It's revenue. No doubt about it. So, I can say tax is something like revenue. Tax is something like receipt also. It is incoming. But if I have to talk about something like a loan which government is taking, it is also incoming money. Loan which government is taking, it is incoming money into government's pocket. Loan is moving in. So this loan, since it is incoming, it is part of what? Receipt. Loan is receipt. But loan will stop here only. It will because loan is not a revenue. Loan will stop here only. If you see this loan is a receipt, but loan is not a revenue. Loan is a receipt. Incoming money. But why loan is not revenue? Because loan has to be paid back at a later date. Loan has to be paid back at a later date. So this loan is a kind of receipt, but it is not revenue. That much is clear? Okay. So what you should understand is incoming money that is moving in. Okay. That is something like the receipt. This is incoming money. Outgoing money is something like the expenditure. Now government's case, there is a gap between this revenues and expenditure. Gap is there. During COVID, gap would have been less or more? More. Why? Government had to spend more money on welfare, migrant workers, Atmanirbhar Bharat packages, etc. But since we were not working, collections, income tax collections, GST collections for the government, everything reduced for the government. That means what happened for the government, this gap has reduced. That means gap has reduced, means gap has increased between the incoming money and outgoing money. Because money was not moving into the government's pocket, but money was moving out of the government pocket. Without revenue, if you have to spend more, without revenue, if you have to, that means what is the problem here? There is a deficit here. Deficit. What is the deficit here? Incoming money is, let's say, 100 rupees, but outgoing money is, let's say, 500 rupees. There is a deficit. Deficit is how much? Minus 400. Deficit is there with respect to the government's budget. But to bridge this deficit, now generally what will government try to do? Government will try to borrow. Borrow? Take loan. Otherwise, without revenue, how will you spend? Your government will try to borrow and spend. Borrow. Okay. This borrowings which the government is doing is nothing but, the borrowings which government is doing is nothing but what? Fiscal deficit. Borrowing which government is doing is nothing but fiscal. As of now, that's all. Okay. But in the deficits class, you will be deriving revenue deficit, fiscal deficit, primary deficit, all that in the budget class. But now, for our class, the understanding is you should know what is fiscal deficit. Fiscal deficit is nothing but the borrowings of the government. Fiscal deficit is nothing but the borrowings of the government. Why is government borrowing more during COVID? Because during COVID, obviously there is this gap which has increased and therefore government has to borrow more. So during fiscal deficit, during COVID, fiscal deficit increased. Fiscal deficit increased. 9.5% of GDP we touched. Okay, fiscal deficit increased during COVID. Okay, and that means if government has to borrow more, okay, government has to borrow more, loan availability for the private player in the market will be less. If the loan availability for the private player is less, it will lead to crowding out, means pushing away private investment. Are you able to get this point? Pushing away. If pushing away private investment means it is a negative for what? It is a negative for our investment-led growth model. More is the government borrow. That is the reason Nirmala Sitharaman madam always says, I will borrow from outside India. You need not worry. If there is deficit also, I'll try borrowing from outside so that loan availability for the private player will be there and the private player will take loans and invest. This is our logic. Are you able to get my point? That is the reason she says we'll try to borrow from outside. But whenever this government is borrowing, automatically it will crowd out. Crowd out means what? Push off. Push away. Which investment? Private investment. Clear? Understood? Take a break. Then we'll
If the government is borrowing just for capital formation, for capital expenditure, then it will not hamper the growth.
See, government is borrowing for capital formation, it is okay. But the logic is during COVID, it was not for capital formation alone. Understood? No. For welfare also. Then that is the problem, no? Yes. Okay. Break is done. I think you're still in a break, like. Okay. So I think investment-led growth is clear, right? And let's move forward. There is one model called Harrod-Domar. Okay. See, always remember in UPSC, general studies, they are not going to ask a specific model, explain this model. Only in optional, you will have such questions. In UPSC, no need for formulae, no need for any kind of extreme graphs for GS. GS is the most simplest as far as economy is concerned. Okay, so, but there is a reason where, in which all questions, I'll show you previous questions where you can also use the concepts of this model. And this model you should know because it is clearly mentioned in the first 5-year plan. Okay, the first 5-year plan, if we see, it says this model is based on Harrod-Dommer model. And suddenly in the second 5-year plan, they keep saying it is based on Mahalanobis, Nehru Mahalanobis model, like that. So you should know what exactly, why they were talking about this model. What is the reason. And first of all, what you should understand is this model or subsequently whatever models we talk about, okay, these are all Western models. Western, that is, it is not for developing countries. These models were basically framed for the developed nations. Now we always have this fascination for foreign, and that is the reason probably that time also we would have decided, no, let's think about putting in Harrod-Dommer. During freedom struggle, anyhow, we did not have so much of scope and energy to think of economic models. So whatever existing models were there, we were trying to fit into our policy making. So, and after independence, first thing what you should understand is, we decided that our prime moving force of our economy, prime moving force, the main entity which will drive the economic growth of India, we said this prime moving force from the beginning, we said it will be what? Industry. Industry will be the prime moving force to drive Indian economic growth process. This is what we decided initially, though in the first 5-year plan, we were saying we will focus on what? Agriculture. Though we were saying we will focus on agriculture, the main moving force, the prime moving force of the growth process of India, we decided to take it as industry rather than agriculture. And we did not take services also. Services, obviously, without industry, you cannot expect services. Only if there is industry, then extension of industry will be services. Okay, so reason, what do you think would have been the logic? What do you think would have been the logic behind, like that time, that point of time, thinking of industry to be the prime moving force is the first question. Why? Why industry? Why not agriculture?
So because before independence, we have witnessed that most of the country become rapidly industrialized and growth a lot because of industry. Like Japan and Britain industrialization and Russian industrialization.
So to stop imports from other countries. Okay, ठीक है, very good. More employment. ठीक है. So one, I'm putting your points on board. He says one is to create something like jobs or employment. I've taken that point. Is it creating jobs or employment? Okay. Two, somebody has mentioned to reduce our dependence on imported items. You are importing capital goods, you are importing machinery. Okay, you have to become something like indigenous, etc. And always remember, we always believe, not only we, all countries have believed that industry will put the economy into the growth trajectory. Industry will put the economy into the growth trajectory. That means industry will make the growth sustained. That means our growth process will become more sustained through industry, because this industry will create jobs. Again, jobs will lead to creation of demand. Okay, and this demand will again lead to creation of consumption, and this consumption again leads to production. Producers will produce. Like this, industry will lead to putting our economy into the growth trajectory. And we want to grow at a faster pace. We wanted to move at a faster pace, and industrialization is the only way to move or grow at a faster pace. So based on this logic, we decided, chalo, let's go ahead with industry as the prime moving force of Indian economy. And since private sector was still not developed during that point of time, obviously our growth has to come from what? PSU-led growth. PSU-led growth. Public sector units are the most important units that will drive the economic growth of the country, because that point of time, private sector is not still developed and therefore we decided let it be government driven growth or PSU led growth, which is completely opposite of what Madam is saying today. So Madam in the last year's budget, she was mentioning that government has no business to stay in business. She clearly, it started off, the budget speech itself has started off with this statement saying that government has no business to stay in business it means that over a period of time, we will also shut down or we will privatize profit-making PSUs also. Profit-making PSUs, not loss-making. 1990s, loss-making PSUs. You are talking about. I am talking about profit-making PSUs. Over a period of time, even profit-making PSUs, if the present government is still going to continue, okay, so government believes very firmly that even profit-making PSUs also, over a period of time, we are going to privatize. Are you able to get this? Okay, multiple reasons for that, that we will see later. So this is one sea change which you'll observe. Now, what is this Harrod Domar? What was Harrod Domar saying? Actually, Harrod Domar model was mainly framed to handle the problem of long-term unemployment. Chronic, you call it as long-term unemployment or chronic unemployment in developed countries. Basically, what is the whole crux of this model is they wanted to handle unemployment problem, chronic unemployment problem in the developed countries. For this reason, for this logic, they have come up with Harrod Domar model. Okay. So what Harrod Domar says is economic growth of a country, if a country has to grow, okay, this country, out of its total national income, some amount of money, obviously, you will spend on something like handling depreciation. Out of the total output, some amount has to get into handling depreciation or worn out capital goods. Yesterday we have discussed, no, that means there will be some machines which are already worn out. So you are going to use that money to replace the previous worn out capital goods. And the remaining money has to be pushed into increasing the economic growth. Remaining money has to be pushed into increasing the economic growth. And this growth will increase if on one side, savings is going to increase. This growth is dependent on, directly proportional to savings, and it is inversely proportional to something called as the capital output ratio. So what Harrod Domar says is, every country which is trying to grow, okay, certain amount of its output, it has to push it into handling depreciation or replacing the earlier capital goods. Whatever is left out, you are going to push it into increasing the economic growth. How do you increase the economic growth? It is basically, it happens only if savings are going to increase. Okay, his logic is very simple, that these savings will get converted into investment, and that means growth is directly proportional to investment and inversely proportional to capital output ratio. Everybody knows what is investment now. We've discussed enough about investment. Okay, so we also decided in the first 5-year plan, there's a fancy line says, we are going to think about, or we are going to use this model called Harrod Domar model. Okay, now first thing what you should understand is, what is this capital output ratio? Okay, so in simple way we'll try to understand. Capital output ratio is confused? Okay. See, the question is like, how a country should grow. Growth is what? Growth is nothing but, I'm talking about GDP. Okay, so growth is nothing but GDP here. Okay, so if a country has to grow or a country's GDP has to increase, what a country has to do, out of its total output, some amount of money or some amount of output has to get into handling worn out capital goods, handling depreciation, etc. Remaining has to move into something like investment. Okay, that means how will investment happen? If savings are going to increase And once savings increase, automatically investment will also increase. Are you able to get this? So growth is directly proportional to this investment, number one, and inversely proportional to this aspect called as capital output ratio. Okay, so growth is directly proportional to investment means growth is directly proportional to new capital formation. This is the net investment. Net investment is what? New capital formation. New capital formation. Yesterday we talked about. Okay, so new capital formation. So investment according to economists is nothing but capital formation. You're coming up with new machines. New machines which can produce other goods. Okay, I think you got my point, right? Okay, so investment multiplied by 1 by capital output ratio. Now what is this capital output ratio is? Capital output ratio is nothing but it is the amount of capital that is needed in layman's term to understand. It is the amount of capital that is needed to produce a single unit of output. Amount of capital that is needed to produce a single unit of output. That is what is capital output ratio. That means how much capital you need to produce a single unit of output. Okay, so that means, for example, in US, I need 5 units of capital to produce 1 unit of output. That means I need 5 rupees, let's say. I need 5 rupees of capital to produce a 1 unit of output. That means in US, the capital output ratio is 5 or 5:1. Are you able to get this point? Okay. In India, if I need 10 rupees of capital, 10 rupees of capital to produce a single unit of output. I need 10 rupees to produce a single unit of output. That means in India, capital output ratio is something like 10:1. In US, capital output ratio is 5:1. Are you able to get this? Now, everybody, now the question is, out of US and India, who is more efficient? US is more efficient. That means what you should understand is, in US, you need less amount of capital to produce a single unit of output. In US, you need less capital to produce a single unit of output. But in India, in a developing country, you need more units of capital. You need more capital to produce a single unit of output. This is what you should understand. That means developed countries have lower capital output ratio. What you should observe here, developed countries have lower capital output ratio. Developed countries, why they have lower capital output ratio? There are multiple reasons for that. Okay, why? They have skilled labor. Skilled labor is there. So with less capital also they can produce better output. Okay, their technology is better. So with less capital they can produce more units of output. Their laws are more better off than India. For example, trade union disturbances are not there. So interference of trade unions or supply chain bottlenecks. You know about supply chain? Supply chain, everybody knows supply chain? What is supply? How many mechanical engineers are? Separate subject for us, no? Okay, so supply chain is something, for example, supply chain is something that connects. Okay, for the agriculture part, what is the supply chain? Anything that is from the farm to the fork. All this connectivity will be part of supply chain. For example, so when I talk about supply chain becomes very important with respect to your delivery of products, etc. For example, today if we talk about Amul, okay, so Amul, there can be Amul, there are Amul ice creams, Amul ice cream shops are there, Amul ice cream shops, it is retail shops of Amul, okay, so that, and you have Amul cooperatives, milk cooperatives, who are supplying milk to this manufacturing unit, So here, Amul's cooperative units are supplying milk to this Amul ice cream factory. And after manufacturing ice creams, Amul is selling its ice creams in its own shops, retail shops, in its own retail shops. So, what is this? This is something like what you can observe here. This is what is backward integration. Backward integration means for this manufacturing company, what is backward integration? Backward integration means I am moving closer to my supplier. Who is the supplier here? Amul Cooperative only is supplying raw material called milk. So this is what is backward integration. Backward integration means I am moving close to the supplier. See, suppliers become very, very important. Why? If you have proper suppliers only, in time manufacturing, quality manufacturing can happen. Okay. But if you have problems with respect to transportation, if you have problems with respect to logistics, if you have problems with respect to taxing, all these issues will make, it will increase the challenges for the manufacturing unit. Are you able to get my point? Similarly, this is backward integration. Very important. Backward integration is very important. Along with backward integration, this is forward integration. Forward integration means I am moving towards the consumer. I'm moving towards the consumer. Forward integration, this is forward integration means I'm moving towards the consumer. I'm getting closer to the consumer. Backward integration means I'm becoming closer to the supplier. Both of these put together is supply chain. Both these put together, both backward and forward, all this is supply chain. That is the reason appropriate cold storage facilities, warehouses facilities, road port connectivity for easy transportation, logistics efficiency, lorry example yesterday I was giving, taxing and all from Chennai to, yes. So all these become very important. That is nothing but supply chain efficiencies. If you have fragmented supply chains, inefficient supply chains, you cannot deliver the product at the right time. And your capital output ratio will also be higher. Your capital output ratio, you will require more capital to produce a single unit of output if you are inefficient even with respect to supply chains. Are you able to get my point? So it's not just about labor efficiency or skills. It is not just about labor, it is also about laws like trade union related aspects. It is also about supply chains. All this is far better where? In developed countries, And that is the reason in developed countries what you will observe is their capital output ratios are less. Lower the capital output ratio, more is the efficiency. Lower the capital output ratio, more is the efficiency. Everybody is able to follow? Okay, lower the capital, higher is the capital output ratio, it is not good. It is not good. In India's case, the biggest challenge is, one is capital output ratios are not stable. Not stable means you cannot assume a fixed capital output ratio because there is lot of fluctuations. Fluctuation? Okay, so that means you will find in first 3 months the capital output ratio is at one level, next year again it changes because it is a very dynamic thing. So in assuming a fixed capital output ratio also like 6, 7 or 10 is difficult in India because capital output ratio also keeps changing in India. But in developed countries you will find capital output ratios are less and constant. Less as well as constant for a very long period. I think you're getting my point. Okay, so you've understood. Now, why in the first plan they would have thought, let us go ahead with this model? First of all, nothing is fixed. Nothing is fixed means roads are not there, power is not there, electricity, manufacturing units, etc. are not set up properly. Labor laws, tax laws, everything was just after independence. Just imagine. But at the same time, you should have some target. You had always targets. Targets with respect to what? We had always, the first important target which we had from the beginning is targets with respect to growth. So, once you know that my capital output ratio, let's say India understood that, yes, India's capital output ratio is something like 5. Okay. And I have to achieve a growth rate of, let's say, 6%. Growth rate of how much? Targeted 6%. Okay, that means how much should be my investment? How much should be my investment? Investment should be somewhere around, how much percent? Investment should be somewhere around 30%. That means your investment should be 30%. I will get to know when, based on my capital output ratio and based on the target I have fixed. I fixed the growth should be around 6% or 6.5%. Okay, so based on that target, based on my capital output ratio, I'll have a estimation that yes, investment should be how much? 30%. 30%. That means if I am producing a products worth 1,000 rupees, I should at least produce capital goods worth 300 rupees. Yesterday we have discussed, no. See, that proportion of capital goods to the total output is nothing but what? Investment. Yesterday we have discussed that proportion of capital goods. Once I know my capital output ratio is 5, once I have decided that I have to grow at a rate of how much? 6%, then I will decide the investment should be how much? Investment should be around 30%. Investment should be around 30%. That means for somebody to plan something, you should have some idea. So how much should be the approximate investment that has to be made to achieve a growth rate of 6%. So you should have an estimation. So that would be something around 30% if the capital output ratio is 5. Are you able to get this? So they would have this kind of estimation, and based on that logic, they said, let's go ahead with this foreign model, Harrod Dahmer. Okay, got the point? But now comes the problem. See, just by adopting different models, you can't become successful. Because this model was primarily in a country where, a developed country, first of all, in a developed country, you have their propensity to save. Their propensity to save is what? High. Just imagine India in 1951. After drain of wealth, after the useless British rule, when you are trying to replan your economy and when you are trying to frame something about how the country will be doing every 5 years, that is what is 5-year plan, right? Okay, so that point of time, our agriculture, we were not doing well. Even industry was a challenge because power, electricity was not there. Okay, and there were multiple issues. Then obviously, banking system itself did not expand. Banking system. Indira Gandhi madam came up with nationalization of banks in 1969. 1969. Nationalization means what? You converted private into government. Madam, you know, no. Madam decides means you should follow. Madam decided nationalization means though the banks like it or not, you have to hand it over. You have to hand it over. And that means, I don't say it is right or wrong. What I want to say is, why nationalization? Then government can set up branches in every nook and corner of India. You can't ask a private bank, go open up your branch somewhere where you will not get business. But a government bank can be set up, branch can be set up everywhere. Bank is needed, no. Oh, if banks are itself not there, where will the savings come? How will the savings get converted into investment? First of all, income is only not there. Income getting converted into saving getting converted into investment, and that investment is going to drive your growth. Are you able to get my point? No. So the biggest challenge is in developed countries, they had the propensity to save. And therefore, their savings will get converted into investment. Then it will lead to capital formation. That means you will have more factories coming up. More factories coming up means you will have more jobs for them, developed country. Jobs. And thereby, they said, we will be handling the problem of chronic unemployment through this model. Are you able to get this? So like through this model, we will be able to handle the problem of unemployment. But India's case, first challenge is our propensity to save itself is less. Moreover, our banking system is not still developed. Everybody having a bank account is not possible in rural India. Even in 2015, when the government is talking about Pradhan Mantri Jan Dhan, 2015 you're talking about Jan Dhan Yojana, means everybody should have a bank account. Then to 1951, without the banking system in place, you are talking about investment and savings converting into investment, and that is going to drive your growth. What is this called? You are crazy and you like foreign economic systems, and therefore you said Harrod Dom. Of course, don't write like this, huh? You can't write Indian government was crazy, therefore we went ahead with Harrod Dahmer. No, Indian you can't write that way. Obviously, we can't write that way, but you can understand that the systems are not in place, which will help you. Number one, are you able to get this? No, you're able to understand. Now, one more challenge. In 1950s, you talk. Even today, we have that challenge. Not only in 1950s. So I said one is banking system is not there. Means there was no. I'm using a word here. There was no financial inclusion. Have you heard of this word earlier? Used in the class? Okay, no problem. Financial inclusion means spreading of financial or banking services to every nook and corner of India. In simple words, everybody should have a bank account. Okay, after 2015, Pradhan Mantri Jan Dhan Yojana only, Modi ji was talking about JAM. JAM, heard of JAM? JAM is Jan Dhan Aadhaar Mobile. Jan Dhan Aadhaar Mobile. Yes or no? Okay, what did the government say? No jam, no bread. Yes, government said no jam, no bread. Means if you don't have Jan Dhan Aadhaar, then you will not be given bread. Means you will not be given food or food grains, etc. This became an issue. No jam, no bread in a developing nation like India. The courts had to interfere. Why? Old woman is there. Now she will be denied ration, saying that no jam, no bread. Okay, no jam, no bread. Now she may say, my retina is not working, the finger is not there, therefore they did not give me Aadhaar card. No, our Prime Minister told, no jam, no bread. This is rules of the book. Following the rules of the book is what? No jam, no bread. But later on we understood that in a country like India, you cannot do this immediately. No jam, no bread is not possible. Okay, you have to take care of them and simultaneously slowly start increasing the issuance of Aadhaar and linking Aadhaar with bank accounts. Are you able to get this? So if we want to achieve investment, first of all, there should be income and savings. This was not realized, number one. So propensity to save in India was less. First problem. Second problem, in India, assuming a capital output ratio which is constant. So this growth is dependent on two things. One is investment. Second is what? Capital output ratio. Assuming a constant capital output ratio is also difficult in India. Okay, assuming a constant, because if the capital output ratio is continuously changing and fluctuating, then how do you decide and use this model? So that was one more challenge. Another challenge is what? Lack of constant or stable capital output ratio in a developing country like India. Second challenge of using Harrod Dahmer model for India. Are you able to get this? Third challenge is in India, unemployment is done. Okay, unemployment is done for you. Now in India, what is the challenge is, in the developed countries, if you handle growth, in developed countries, if you can increase GDP, in the developed countries, if we can increase GDP, you will be growth if you are able to handle in developed countries, you can also create what? Jobs. But India is different. Though your GDP is increasing, okay, if you would have understood, have you heard of this word called employment elasticity? Discussed in class? Okay. Okay. No, wait. I'll ask you another question. Okay, so the question is, when we talk about jobs in India, India faces a problem of jobless growth. Better I will use this word. Okay, jobless growth means what? you have GDP, growth is there, but jobs are not getting created. Jobs are not. That means just using Harrod-Domar model, if you can increase GDP in a developed country, you will solve the problem of unemployment. But in a developing country like India, just by increasing GDP, you cannot solve the chronic unemployment problem, number one. Why? You have problems of disguised unemployment. Heard of disguised unemployment? Okay, so disguised unemployment is directly linked to agriculture. Along with that, you have seasonal unemployment problem. Okay, and after 1990, which sector was mainly contributing to our growth? Which sector was mainly contributing to our growth? Services. Services. That means this is basically, we use the word called over tertiarization. Heard of this? See, primary, secondary, tertiary. Tertiary means what? Services sector. Over tertiarization means services sector is contributing to the major chunk of our GDP. Services sector is contributing to almost 54% of our GDP. This is called over tertiarization. And this over tertiarization and service sector was growing at a faster pace, and this growth is there, but this service sector was not responsible for creating adequate jobs for everybody, and therefore we were facing the problems of what? Jobless growth. Okay, so how can Harrod-Domar, which has handled unemployment problems in a developed country, handle the same unemployment problems? That means solve the problems of unemployment in a developing country like India. This is the third challenge. First challenge, savings, propensity to save, less. Second challenge, capital output ratios are not constant in India. You cannot assume a constant capital output ratio. Got the point? Third challenge, India faces jobless growth. Just by handling growth, you cannot solve the problem of unemployment specifically in India. In developed countries, unemployment can be handled because mostly developed countries, unemployment is cyclical unemployment. Unemployment is done, no? Cyclical unemployment. What is cyclical unemployment? Demand-driven unemployment. Cyclical unemployment happens because of lack of demand. So if you create demand, automatically jobs will get created. If you create demand, jobs will get created. Cyclical unemployment. But in India, along with cyclical, you have disguised unemployment, you have seasonal unemployment, you also have structural, where there is a mismatch between the skills required for the services sector and the skills our people have. Agriculture to IBM is a difficult task. How will you shift people from agriculture to IBM? Difficult? Okay, so that is a challenge. So how do you use this model? These are the challenges. Fourth challenge, last challenge is also there, is in developed countries like US, investment which he is talking about was mainly private investment. Investment which he is talking about is private investment. In India, in 1950s, 1960s, the investment which we were talking about is what investment? Public investment. 2018, we started talking about private investment. After COVID, in the budget again, we are talking again about public investment. Today also we are saying public investment also is very important, public investment in the budget. Why? Because India's case, the private player will only invest when the public investment happens with respect to infrastructure. Is this clear? Understood, Harrod-Domar? Okay. So put the heading Harrod-Domar. Yeah. Is this clear? Understood? Okay. Write down. Harrod-Domar is a, write down, Harrod-Domar is a model of economic growth. Harrod-Domar is a model of economic growth. Model of economic growth in development economics. In development economics. developed by Herod in 1939. Developed by Herod, Harrod, Herod in 1939. And Domer in 1946. Developed by Herod in there are two. Developed by Herod in 1939 and Domer in 1946. 1946. Next point. Next point. The model focused on understanding economic instability. The model focused on understanding economic instability by analyzing the dynamic nature of capital and investment. Like capital and investment. Okay, next point. Next point, third point. Major economic determinants like natural resources, population, technological growth, etc. Constantly influence two important factors influencing growth. Two important factors influencing growth. One, rate of investment. Two, capital output ratio. Is that okay? Then write the formula. From savings you will write economic growth is equal to savings into 1 by COR. Write down. Economic growth is equal to savings into 1 by COR. 1 by COR. Below that you will write investment into 1 by capital output ratio. 1 by capital output ratio. Is that clear? Same thing, no? You have written this first, savings into 1 by COR. Below that, write down investment into 1 by. That means his logic is savings will get converted into investment. Okay. That is what I mean. Savings into. Then put the heading capital output ratio. Capital output ratio. Capital output ratio is the ratio of capital to output. Write down. Capital output ratio is the ratio of capital to output. Okay. Full stop and continue. It measures how much of capital is required. It measures how much of capital is required. How much of capital is required per unit of output. Per unit of output. Okay. That is, if more capital is required, if more capital is required, if more capital is required per unit of output, per unit of output, per unit of output, then the capital is less efficient. Then the capital is less efficient. Okay. So then you'll write down capital output ratio is equal to capital divided by output. Capital output ratio is equal to capital divided by output. Is that okay? Capital output ratio is equal to capital divided by output. Okay, then write down higher the capital output ratio, higher the capital output ratio, it is bad for the economy. Higher the capital output ratio, it is bad for the economy. Okay. Bad for the economy. Put an example there. If capital output ratio is 4/1, write down. If capital output ratio is 4/1, that means rupees 1 unit of output is produced. That means rupees 1 unit of output is produced from 4 units of capital. From 4 units of capital. Is this clear? Okay, then put a note there. Put a note there. Clear? Capital output ratios are lower for capital output ratios are lower for developed countries. Capital output ratios are lower for developed countries in comparison to developing nations. In comparison to developing nations. Is this clear there? Okay. Then put the heading, relevance of Harrod-Domar model. Relevance of Harrod-Domar model. 1, write down. First point, the model was devised for the developed countries. The model was devised for the developed countries. Devised for the developed countries to handle chronic unemployment. Chronic, CHRONIC. To handle chronic unemployment. Okay. Chronic unemployment, long term. Okay. Next point. The model focused on accurate capital output ratio, and high propensity to save. Which was generally absent for developing economies like India. Which was generally absent for developing economies like India. Okay. Continue. More, full stop and continue. More the investment in capital, more employment is generated. More employment is generated leading to higher economic growth. Leading to higher economic growth. Okay, next point. The model believed in virtuous cycle of increased savings, VIRTUOUS. The model believed in virtuous cycle of increased savings, transforming into increased investments, which results in higher capital stock, causing higher economic growth. Okay, simple, same what we discussed only. So, only the English there. Virtuous cycle means here, what it was believing is increased savings, okay, will lead to increased investment. Increased investment will increase the capital stock. Increased capital stock will also lead to increased jobs. This will lead to increased economic growth, and that will again lead to increased savings. This is the virtuous cycle which the Harrod-Domar model was talking about. Are you able to get this? This is the virtuous cycle which the Harrod-Domar model was talking about. Is this okay? Okay, so this is the virtuous cycle. Savings, investment, capital stock. Okay, capital stock. Okay, sorry, here I think it is better we write this way. One second. I will put this way. Higher capital stock. I'll write higher growth. Okay, then jobs. Okay, virtuous cycle will be like this. Okay, and then this will lead to again what? Increased savings, and this is a virtuous cycle which will continue. Is this okay, everybody? Okay, then put the heading limitations of the model. Limitations of the model. 1. It is difficult to increase the savings ratio. In low income countries. It is difficult to increase savings ratio in low income countries. Okay. Is this clear? Okay. 2. A sound financial system is lacking in many emerging countries. A sound financial system is lacking in many emerging countries. That is increased family savings. Need not be rooted through the banking system. Increased family savings need not be rooted through the banking system. Next point. High informal economy. Last 2 minutes. High informal economy. I can understand your pain. High informal economy. Write down. Otherwise this will not be over. high informal economy. Informal economy, see informal, don't write this, high informal, let me, see informalization means money is not getting routed to the banking system. More informal economy means less money into the banking system. Tomorrow I'll talk about it in detail, but you just finish this off. Next point, due to human capital deficiencies, write down, due to human capital deficiencies, capital output ratios are higher. Capital output ratios are higher in developing nations. In developing nations. Next point, R&D requirement, R&D, research and development, R&D requirement to enhance capital output ratio, R&D requirement to enhance capital output ratio is frequently underfunded. Okay. Next point. Borrowing from external sources leads to debt trap, DEBT, debt trap, leads to debt trap. Okay. Debt trap, I'll explain this term tomorrow. Okay. So leads to debt trap, I'll explain it tomorrow. Last point. Yeah. Yes. Last point. Yes. A rise in capital spending, last point, a rise in capital spending is not always a precondition, for economic growth and development. Is not always a precondition for economic growth and development. That's all. Chalo, done.